Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, Phil Tarrant. How you going? Welcome to Smart Property Investment Show as we unpack mortgages, real estate, property investment, the budget, the economy, and everything in between. We're at that pointy end that we get to a couple of times a month where we talk about money being debt and mortgages, the enabler that keeps driving forward your property investment portfolio. I get together from the team at Finni Mortgages, and they come in and they share their insights and views and opinions of what's going on. In the studio with me today, Eva and Julie from the Finni team. Gang, how you going?
Hello, good.
Hi,
Right,
good.
right. How are you?
Big day for you guys. I'm sure everyone's already been calling you up. We're chatting on the back end of a day where the Reserve Bank of Australia has got together and have decided, as expected, to leave the official cash rate as it is. I guess that's good news, is it, Eva?
Oh, it could be worse. They could have hiked again, but I guess it's a bit of a we can breathe for a minute type of situation for everyone.
What does this mean, I think, Julie?
Well, it helps, I guess, if people are looking to do any lending. Obviously, if rates go up, it affects their borrowing capacity. So at least it gives a little bit more certainty around, for now, what they can borrow.
Yeah, and no change is good, and everything I'm reading sort of indicates that the next movement will be down, and I think most, if not all, of the major banks now are now pricing in interest rate cuts or cuts to the official cash rate.
Westpac is the only one out still.
So they haven't. Westpac hasn't said anything yet.
Yeah, I believe they're still planning a hike this year.
So Westpac still says hike and one more hike this year, whereas all the other banks are saying
we are at the top.
We're at the top and the only way down, and there's going to be some cuts next year. So let's see. Well, maybe Westpac knows something that we don't know.
They keep changing like every week. It's something else, something new. A few months ago, they were all planning a few more hikes this year. So
we've seen some of the banks come out with just rate drops in the last week or so around their fixed rates as well. So
let's talk about that. What does that mean?
Well, normally when I think they try to lock people in sometimes at a decent rate, but the fact that they're dropping might mean that they're dropping the rates. I don't know. Can you get it? I just couldn't speak.
Yeah.
Sorry.
They're dropping the rates.
Cut that bit out.
I'm sure they can do. They leave it in there, but that's the reality of the world. When banks start bringing down the fixed rate, would typically telegraph and indicate that they're expecting rate reductions. So banks are smart folks. They know what they're doing, and they want to try and drive as much income as they can.
Lock people in at the top of the cycle.
Yeah. Did we see the last time there was interest rate reductions, and we had some cuts, and then they went up 3 times this year? This is the fourth meeting this year, isn't
Correct.
it, today? Yeah. And they didn't go up. Did every lender pass on 100% of the cuts on the last downward cycle? I know all the majors did, and most of the second tiers
Yes, I want to say yes. There might have been some that delayed.
Some of them didn't
delayed.
pass it on immediately, and then they passed it on later. So there was other banks, second tiers, that when the rates went up, they didn't pass it on immediately when it went up.
Okay.
Grabbed some business, and then they adjusted them out of cycle,
Yeah,
and they
there was
went
a
up
bit of that.
0.6%.
Oh, really? Okay.
There's been this case as well, this time with Bluestone not passing on the hike, the latest hike for SMSF.
Okay.
Right? So what that does, and it might be, in a very clever way to bring in business looking much cheaper than everyone else, and then passing it on later, or maybe leaving it on the lower side, but that would bring business in.
That's what one of the other lenders did as well.
So there's always a bit of tricks there happening. What that does, having rates on hold, is at least it sort of flatten the line, and you can compare better each bank where they're at, because it's really hard just after a hike or after a drop to know, okay, has this one passed on the hike yet, or this one hasn't? I don't know. So we've had clients coming back to us saying, well, I refinanced actually on the high, right? But I thought it was lower because at the time they didn't pass on the hike.
Yeah. And this is what banks do, and hence the reason why you really need to speak to a mortgage broker in that. A lot of them, if they're looking to grow market share or grow their book, they'll keep their rates at a particular setting just to attract more business. And your mortgage broker will know about this. You're probably not going to know about it if you're going directly to them. So make sure you do get into the weeds and the depth around it all. So no change to the official cash rate. That's gives a sense of a reprieve for a period of time, at least for borrowers to know what their mortgage repayments are going to be. And if and when we do get to a downward cycle, the last couple of cycles I've seen, all the banks and most of the secondary banks all pass them on. So I think there's an expectation now that rates are passed on. 10 years ago, people would pass on parts of it, some of it, none of it, all of it.
It's much easier to refinance as well now than it used to be.
Yep.
So I guess there's less that feeling of being locked in. I guess what people need to be careful of is when they fix their rate at the top, it's very costly to break down.
Can you pull
loan.
that apart for our listeners that might not be familiar with what you mean by
The
that?
break fees, yeah. So when you fix your rate, let's say at 6%, and the rate goes up, the variable rate goes up, it costs nothing to break your loan contract because the variable rate is actually going up. So the bank's happy for you to break it, you're going to be on a higher rate. On the way down, so if you fix at 6% today and tomorrow it's 5.75, it's on the way down. The bank won't be happy for you to break that down. So the fee is going to be huge, especially if your mortgage is a big one. The bigger the loan, the bigger the break fee would be. And also the longer you wait, so if you fix at 6 and it's now 4%, the break fee be huge. And also depending on how long you fixed it for, 1 year, 2 years, 3 years, if you've got a long time remaining on that contract, it can be like tens of thousands of dollars.
Yeah, how far into the term? Because obviously the bank then secures that funding for you at that rate. So they're obviously banking on how much they're going to earn off that. And then if you decide to break it, they're going to charge you a penalty.
Yeah, bank always wins. Don't even try and game it unless
it's hard to win when you fix.
Yeah, well, a lot of people won when
1.99.
they and I wish I did. So I fixed some loans when interest rates were like at 2.something%, right?
Yeah.
And I didn't fix it long enough. I think I did 3-year fix or something or other, which was great. I know some of them did 5-year fix, but and they're now just really coming off. A lot of them, it's just sort of.
There's 1.99%.
1.99%.
They were the days.
Them were the days, right? So a lot of people had a
good run.
Good 5 years, fixing so they won in those regards, and you win and lose on fixed rates. I've won on both. I've been locked in at fixed rates, which are much higher than the variable rates, purely because I fixed at the wrong time, and I haven't fixed since, other than during when rates were at all-time lows. But this is sort of advice that your mortgage broker can really help you out with, to actually understand what the objectives are around fixing and keeping it variable.
And sometimes it's good to even hedge your bets. You can split your loan, obviously. So if you are sort of worried about certainty of repayments and cash flow, you could fix a portion of it to sort of lock in that repayment, so you're not going to be affected by rate rises, but then keep some of it variable, because then you can have the offset still attached to the variable rate as well. Most of the fixed rates don't offer an offset facility.
And if you're doing fixed P&I, even if you completely offset that loan, it will still take the full amount in repayments every single month, right?
There's no offset for most. There's only a product or two in the whole market that has an offset for a fixed term.
Yeah.
So offset just on.
But on a variable, even your P&I, it will offset the interest. It still takes the monthly repayment, as you said, and it pays it off the principal.
Yeah.
So
you got to be careful with that. So if you offset a P&I loan, interest only, a P&I loan, if you offset it and then your repayments clear, the principal debt on it, that means you can't get that back, right? Typically, they just discharge the loan straight away.
Oh no. Depends. If you put in the offset, they would just sit there.
Yeah, but if you actually put it against a redraw and it keeps sort of drawing down on it, you got to make sure you keep enough debt in there so it doesn't conclude the loan.
Yeah,
right?
there's a risk of that.
yeah, because if say your repayment is $5,000 a month and $4,000's interest, then you've got enough money built up in your offset to cover the interest payment. The $5,000 that will just be coming off the principal every month, and as you said, slowly reducing the balance. So you just got to keep an eye on it.
Have you seen that happen? And people go, "I didn't mean to do that. Can I get my loan back?"
Yeah, when I was at CommBank, it happened a few times just because they weren't aware. We were able to reverse it, but it's more having the conversation as well. And if it, some people want to pay it down to say 10,000, have the money in redraw, but keep it available. So then it's going and adjusting, because the banks can then adjust the minimum repayment based off what the current balance is. Yeah. So then it might be $2 a month is the minimum.
But they'll want you to capitalise that into the loan rather than keep it as a redraw, though, wouldn't they?
You can have it into the redraw, and then you can actually ask for your repayments to be recalculated based off the current balance.
I've tried to do that and I haven't done it before. Yeah. Can you? Will they do that? Yeah.
Yeah.
Yeah. I was through the major bank. And they went, no. You've got to. They wanted me to capitalise into the loan, and
no, in my banking previous life, we were able to do it quite a lot.
Okay.
I've seen clients that have done it again, so it may be dependent on the bank, but they're just mindful that if you do take money out of the redraw, your repayments will go up. So you need to sort of recast your repayments again, essentially.
And this is the thing with redraws. You want the flexibility of driving down your interest and paying off loans potentially, or paying down the principal quicker, but you still want the liquidity connection, right? Like, and you can get money out of a redraw facility reasonably easy.
Most of the banks do. Some of the smaller lenders have a little bit of a restriction, but most of the mainstream banks, you should be able to access it via online banking, or a phone call. Yeah,
but they won't let you take out full tranches. You just got to take them out little bits and bobs.
It would depend on either what your net banking or your online banking limits are, your transfer limits, or some of the banks might have a minimum or a maximum that you can take out per day out of the redraw facility on the loan.
Yeah.
You can have an offset. It's kind of easier, I think, too.
Yeah. It depends what sort of loan that you have. If it's a P&I loan. But so back to rates then. So a bit of certainty for a little while, but I don't think anything's certain at the moment. Considering what else is going on with property investment. We'll chat about that. We'll just go to a quick break. Stay with us back in a moment. G'day, Phil Tarrant here. Before we get back to the Smart Property Investment Show, I want to share something important. Yeah, that's right. They got me doing adverts now. But seriously, as an investor myself, I know how critical finance is. For years, I've struggled to find a consistent solution that supported my property investing journey. That's why I was part of setting up Finni. Finni's a mortgage broking business built exclusively for property investors. They understand the complexities, they deal with investors, and no matter how tricky your finance needs are, they've got the expertise to make it happen. So if you want to get finance ready and invest the right way, make sure you're backed by the right broker. Talk to the team at Finni Mortgages and find out how the right finance strategy can help improve your investment outcomes. You can book a consultation today. Visit finni.com.au. That's FINNI.com.au. Welcome back. Phil Tarrant chatting with Eva and Julie over at Finni Mortgages, finni.com.au. I see you got a new website, Eva.
We do.
That looks a bit fancy.
It's much nicer than what we used to have.
Yeah, it's looking good.
It's great, yeah.
It's got all your brokers in there. And
looks more, it's very clear on what we can offer, what we can do, how we can help people from, the very beginning of the journey to a lot more complex investment
it certainly
structures.
sets your stall out as a business that's built to service probably more sophisticated clients as well as those that just need quite simple borrowing. And most brokers could do simple borrowing. Simple borrowing might just be, my first home. And
that's great. We love those too.
Yeah. Do you get much of them? It's
we do.
It's one of the danger of sort of positioning yourself as experts in a particular area. People think that you don't do the other stuff.
But,
we can do everything.
Yeah.
And sometimes they're clients that you want at the start of that property journey, because then in a few years they might be then ready to dip their toe into the investment market and use some of the equity that they've got.
How important is it to get the first loan right with a view towards building
so important. And then what you mentioned with redraw and offset, that would be a very big mistake you would make, having a redraw only on your own OC if potentially you're going to turn it to an investment.
Sorry, let's talk about that. Explain that. You're going to have to be a bit slower.
Well, let's say my first home buyer is buying its home on its own, decide that an offset will need a package loan, it's a bit more expensive.
Yeah.
They will stick with the redraw. They put all their money in redraw, and then 2, 3, 4 years later decide that their home is not more suitable, turn it into an investment. What happened then is the home loan, the only part that would be tax deductible now is the loan limits
balance
minus the redraw, so the balance.
Really? So they would assume the redraw
is no more tax deductible.
would be connected to the original
to whatever is
purpose.
next.
Yeah.
To whatever next. So let's say they had the home loan for 600, put 200 in redraw, only 400 would be tax deductible for their
If they
now
turn it
investment.
into an investment property.
Yeah,
Okay,
yeah.
so they'll go at the point in time when.
Yeah, but if, and it's going to be very important now for people having home, that they will turn into investment because of the budget,
Yes.
right? So as opposed to this, if they talk to a broker or Solid, their first purchase was an offset, $600,000 loan,
Yeah.
all in the offset, $600,000 is tax deductible.
Okay, if they turn a
That
principal place of
home
residence into an
into an
investment
investment.
property, so if the money's in offset, it's all going to be tax deductible. If it's in a redraw, whatever
not
it
a
is, and is that going to be at the point of time when they turn into investment property, as long as the old regime still exists, or
Well, if
Yeah.
they bought the property before the 12th of May, 2026, 7:30, before.
But they're basically looking at just the balance of the loan. So redraw brings down the balance of the loan. The offset doesn't bring down the balance. It just offsets the interest charge against it. So, and you can only, claim against what the balance of the loan is.
I think there's a bit of misinformation going around also, and I think even the Prime Minister was talking in this regard, saying that the reason why they didn't propose you could only negative gear 2 properties was that everyone would just constantly just top up their loans against them, and that's not necessarily the way that would work, right? You can't just keep negatively gearing.
Well, really, if you get some top up, it has to be for an investment purpose. It's not coming from the source of the property; it's where it goes.
Yeah.
It's the funds. So you can do, it said you could, if you had no equity in your investment property and you needed to do some renovations to it, you could use equity in your home. That loan is still, the purpose of it is for the investment property, so it's still tax deductible,
over there, but
even though it's against your principal place of residence.
But if you pull money out of a negatively geared property and you deploy that money that you raise through equity into another property over here, that money that you're taking out applies to the new property, not the existing property.
Correct.
So the debt to value ratio stays the same on that asset,
Yeah.
which means that it will become positively geared in time. Largely how it works, and I think this is the big sort of misinterpretation of how this all works, because people think that you just keep pulling out equity. These properties keep negative gear, but it's where you use and deploy
where
that
it's going
money
into
rather
purpose,
than where it comes from, and people need a lot of clarity on that. So the argument there is that all largely negatively geared properties should in time become positively geared.
Yeah. I think it's the timing that was underestimated. Like within 2-3 years, most property aren't positively geared.
Yeah, it depends how negative they are, but
There's been a good time, I guess, a good run. People buying property in Perth. I think you bought one there probably from day one. It was positively geared. Like people will try to find those properties in this market, but it's not. It doesn't take like 2-3 years, I don't think.
No.
From what we see, and we deal with a lot of investors, it would take 5+ years.
It depends where you're buying also. Like if you're in a place like Sydney, if you think of like western suburbs of Sydney, you're getting some reasonable capital growth out there, but the rents certainly aren't keeping up. The yields out there are pretty sort of uninspiring, right? For freestanding houses in the western suburbs of Sydney, rents are, what you're probably getting median prices at 1.2, 1.3 million, and
like
probably getting
2%,
rents at 650, right? Like they're really negatively geared.
Yeah.
And
that
probably
will take
be
more
for
than
years.
Yeah,
It's probably 10 years you got to wait around in order to see any sort of upside from that. So certainty in that rates haven't changed, but lack of certainty in relation to what the budget will look like. And as we're recording now, they're still sort of working through that bodywork in the Senate to see how it's going to land. The expectation is that that first sort of package, which has 4 bits to it, will go through to becoming legislated, and that is the changes to CGT and negative gearing, and running in parallel with those tax cuts that the government loves to tell us about, that $250 more a year and $1,000 instant write-off a tax return without any evidence around it. Like that's all going together as 4 things, and if the government tells you that people are voting against tax breaks for people, now it's because of the package all up together. I think the opposition is voting against the fact that there's CGT changes and negative gearing in it. So, there's a lot of rhetoric around it right now. But look, that looks like it's going to go through. So at least we'll know what the world looks like moving forward. Is that really changing much for people? I guess that the key thing is around serviceability, because some lenders now have already factored in these changes to serviceability, and other lenders will start to factor them in moving forward. What's the status on that right now?
It's a bit all over the place, to be honest. Like Macquarie moved first and said no more negative gearing. Then they came back saying, well, actually the fact is you can still offset income against the rent, so we'd put that in the calculator. So they've changed that. Some lenders are completely like, we're not gonna...
Is that just for the next year or just...
No, it's happening now.
I know, but they're only making that available for next year because you can still negative gear.
No, it's new.
So what's Macquarie doing now? They're actually, because...
So they've got a new calculator where you can still offset the income against the loan. So they're doing, yes. Yeah.
Yeah.
Confusing.
Very confusing.
Yeah. Okay.
And then you've got some lenders that did, we're not going to do any more negative gearing at all. We'll just see what happens. But at the moment, it's off.
Yeah.
You've got some lenders that said, if you had a pre-approval in place, we'll just honor that because it's too hard for us to do rework on. We love those because that secures our clients. Obviously, that push people to move quickly as well, and maybe not in the best property, but
a lot of them are definitely adopting it.
up.
I had a client that had bought a property, had signed the contract the day after the budget hand down, and the bank it was one of the majors they're applying the new ruling. So he had to change his loan amount down and drop from interest only to P&I to be able to get the loan through for what he needed for the purchase.
Making a huge servicing difference.
Yeah. And there's another thing, right? Moving loans from P&I to interest only P&I can really change your serviceability footprint as well. So these are little nuances.
It's really hard for people with yield that is so difficult at the moment. You know, when you pay like 6.5% and yield is like 3%, to go on P&I, that's a really big gap.
And I had a pre-approval for this client as well. So it was pre-approved, obviously pre-budget, but because it wasn't approved, they're assessing it at the new rules, and it was hard for him. He's a first time investor, excited to get into the market. Using parents' property as a family pledge for his deposit, all ready to go, and then spanner in the works because contract was signed one day late.
Yeah, and these are a lot of these young people. Imagine they're a young person, sort of sitting at a family pledge or complaining about the rules being changed and it's stopping them from getting on the ladder, right? And you hear this rhetoric around the issue is that there was a couple of rungs missing from the bottom of the ladder, and that's what the government's trying to do, is trying to remedy that. But that more rungs have been pulled away from that ladder in order to get on to the property ladder. So this is really contentious. I don't know if everyone saw the 60 Minutes on Sunday night. I'd sort of recommend you go and tune into it, which looked at, I think it was called, off the plan or something or other, as in like they're completely off the plan, not off the plan properties. And they had some young people in there telling us why it was all wrong, and the treasurer was there telling us why it was all right, and some other real estate commentators saying how it's really going to change things moving forward. I think the consensus now is that economists there pretty much saying, hey, these changes to that they're trying to introduce and will be legislated, it looks like, around capital gains tax and negative gearing will make an impact, but probably in 20 years' time. So they're now already calling sort of the young people of today, which I imagine are in their 20s and 30s and even into their early 40s, are going to be the sort of forgotten generation when it comes to property, right?
My son's saving at the moment. He's 23, just finished his master's, working full time. He's saving to buy a property, and even with everything going on, it's like we were even thinking about going down the route, getting him into an investment property first, get your foot in the ladder, but that's sort of off the table for now.
Yeah. I think the old-fashioned way people used to create wealth would just keep trading up their principal place of residence, right, until they get to a point when they go, well, I don't need a massive house anymore, I'll sell it, and then that money gets realised and that sort of supports a pension. I think that's going to become a lot more popular moving forward rather than...
It's limiting though.
What's that?
It's very limiting.
It is very limiting, and you're sort of wed to where you want to live actually performs well.
Yeah, or can you first afford to buy where you live?
Yeah, and it's a challenge for a lot of people. This whole idea of investing for many is sort of over because the negative gearing doesn't stack up, and serviceability. So let's talk about that. Let's go to another break. Back in a moment. Welcome back. Phil Tarrant, chatting with Eva and Julie over at finnimortgages.com.au. So getting into the market has become a lot more harder, and all the same tools are still there. Family pledges, and if you're a property investor, family pledges can be leveraged to get you into the market with a 5% deposit, because
Zero.
zero essentially.
Zero.
So that all exists. If you've got parents who
105% lend.
105% lend, who can really appreciate the opportunity around it. But this is the problem now is and this is what they're trying to disincentivize, is people putting and using property as a way to create wealth as an investment class, and it should be a class of investments for people to live in. So whether or not you're going to get the returns that you used to in and around property, who knows? The point is, though, is that where do you put your money then? Because it's going to be taxed the same way everywhere else. So most property pundits are saying, it'll just normalise and standardise, and maybe you won't get the same growth rates, but is it going to be better than other asset classes? And can you still get leverage in and around property, which you don't get in other asset classes? Probably. So that's the argument for it. But for those with an investment portfolio already, it would be a good time to be thinking about, what's next in terms of portfolio creation or balancing up your portfolio. So refinancing and having that money ready to deploy at a point in time. Refinancing has changed a bit because of serviceability requirements.
And look, we've seen that a few years ago already, when rates started to go back up after COVID. So I think people feared that their property price would go down. So obviously, the less the property is valued at, the less equity you can release.
Yeah.
So there's probably a window now for like the next 3 months or so where it's a good time to revalue your portfolio, get the cash out that you can get out, because you don't know if you're going to get it later. And then position yourself with a pre-approval that might be still honored with negative gearing, even if you're not technically going to get it.
Yeah.
Once that window closes, there's a lot of people that would not be able to do anymore.
Evaluations stacking up at the moment?
So
Are they
far,
starting to come
because
down?
there's a 3 months delay,
Yeah.
right? You buy a property today, sell it in 6 weeks. It takes time to show the results. So at the moment, it's still showing up top of the market.
Yeah.
In 3 months' time, it might be showing a bit of a drop.
Yeah, I'd imagine valuers will start getting very conservative moving forward, and you may be in a point where you're contracted for property where valuations don't stack up, right? Which means you're going to have even bigger shortfalls.
Short valuation,
they've been. I've had a couple of instances recently when I have been looking to refinance a client, and he's done his own research of he'd bought something, what had recently sold, but the valuer just wasn't coming to the party yet to try to vail it up at what he thought it was. So, and whether it's just that delay coming through.
Yeah, I think valuers will come out of the woodwork over the next period of time, because all property is going to need to be valued on 30th of June 2027. So that's going to be an absolute nightmare. And a lot of people there will try and value up their property as high as possible, right?
Yes,
so just to factor in, because you've got to be preserving the 50% CGT up until that point, and then it'll be indexed. So
it's going to be interesting.
That's going to be a big game that a lot of people will play, and no doubt when there's
It'll be
rorts,
interesting though, like what valuation are they going to accept?
Yeah.
I think the valuation from
accountants,
valuation from real estate agents that just write a letter, valuation from a bank, valuation for actually certified valuer.
I don't know. All I know is there's a whole bunch of valuers going to be created, and it's all going to be a bit.
I was just thinking they're going to be the new boom.
Yeah.
The new boom.
Yeah, and it's going to be it's going to be the Wild West, I'll tell you. Like seriously, it's going to be the Wild West.
Yeah. Well, we've seen that with buyers agents.
Past
few years now, it's
God.
values.
Well, it's a buyer's agent space. There's interesting times for them with one of those major ones. Sort of, do you see the numbers around that?
Yes, shocking.
So 16 million? 16 million owed to creditors.
Yep.
About 11 million owed to deposits and refunds.
Yeah.
Which the clients aren't getting back.
No.
I had a client refer
It's
his
huge
friend.
numbers. Like a deposit is what, like $5,000?
No. Their deposits were, I think there was 670 customers to receive back about $11 million. So
Yeah, but like each client, how much is a deposit?
well, some of them pay completely up front
Yeah,
for buyer's
I had a
agent service,
client-
$23,000.
Right.
yeah, some paid a $5,000 up front, not getting that back. Some
Yeah.
had paid in full.
I've heard some people paying 2 and 3 times services up front, like $60,000. You know, so yeah, that's
That's a lot.
yeah. So I'm also hearing buyers agents, people calling out buyers agents, not the one that we're talking about there specifically, but other ones saying, "Oh, can I have a deposit? Can I have my deposit back, please? I'm not going to buy now." So
Yes,
yeah, this is happening.
that's happened as well.
This is happening, and I see some buyers agents. I got 2 emails just this week of 2 different buyers agents telling me they're putting their fees
Yes.
up.
We
So
saw that
Yeah,
too.
I've had that. I've had client, obviously, when we speak to a new client, they're talking about investing. Ask, are you looking yourself? Are you going to use a buyer's agent? I've had a lot of people, oh no, I'm going to be doing it myself.
yeah, and there's nothing wrong doing it yourself,
Yeah,
right?
100%.
Like,
If you know the market and you know, if you've got the time
Yeah.
as well and you know where you want to buy, why not?
I've probably copped some criticism for saying this, but I would say your mortgage broker in this market, well, most markets, but this market specifically, is going to be a lot more integral in terms of supporting portfolio investment decision making than a buyer's agent. That's just one small part of it. Is what you buy, where it's whether or not you can buy is the
and
key
that's
thing. So
gonna
they
be
really
tricky.
need to start. So I
And
can
that's
see
where
real
people need to start. It is sort of have that conversation straight up and
Yeah.
actually see where your serviceability sits, what your options are,
Yeah.
because they might decide, oh, I was thinking I could get 600,000 property. It's only going to be 450. Do I want that? It might be second tier lenders. The rate's going to be higher. Do I want? So have that conversation up front.
Yeah. It starts with your broker, absolutely, rather than the buyer's agent. And would a lot of your clients be using a buyer's agent, or some do?
Yeah, a lot of them. But we do feel the shift as well of people saying, I'm going to use it myself, because a lot of them in the last few years have said, it's home and land. You need the land component, blah, blah, blah. It's always where it goes. And then all of a sudden, because capacity has reduced, they're now offering off-the-plan units. And it's like, well, where is their loyalty and integrity to? So we do have a lot of clients saying, well, I'm just going to go and do it myself based on what I know.
Yeah, a lot of people sort of shift into units and chasing yield, right? Because
yield and lower price.
Yeah.
Yeah.
Certain unit markets are performing really well.
Yes, that's right.
It's just other markets, which are particularly prestige markets, are really starting to really come off the boil. So if you are looking to refinance, and one pathway which works for a lot of people is refinance and just put that money into an offset account and just leave it there, because it means it doesn't change your position in terms of what you're paying in interest, but it means you have dry powder that you can deploy, or you can just leave it there ad infinitum. I know lenders don't like you
Doing that.
refinancing and brokers as well, right? Refinancing parking the money,
it will help you
because
servicing, especially if you've had your mortgage for like 5, 6, 7 years. Going back to 30 years does help you servicing for the next property, and people forget that.
talk about that for a second.
So, let's say you've had your mortgage for 7 years. You've got 23 years on paper to pay down the capital of it, principal of it. So, obviously, the repayment on 23 years to go would be higher than if you stretch it back to 30.
Yeah.
So you might, I don't know, on a $500,000 mortgage, you might get $300-400 back every month. If you got 4 or 5 properties, that's enough to potentially service a new property.
And this is the detail you need to go into. And that's where it needs to start before you even think about where and what you're going to buy.
Yeah. And then it could be, so that's for servicing, to get the valuation, to get the equity out. You're not going to buy a property if you don't know your servicing, if you don't know how much cash you've got to put in, and if you don't know also what lenders would look at your situation, if you're self-employed or casual or mat leave or whatever it might be.
And it's about what your goals are. Like, obviously, if you're refinancing your loan back out to 30 years, essentially, because you've already paid 7 years off, you will pay more interest over the life of it. But it's, the means to the end. If you want that to refinance to get your repayments down, which helps you to get more servicing to buy something else, well, then it's valid.
You're adding to your asset base. And I'm assuming that you're back property and you're making the right investment decisions. Just don't assume that property always goes on value. How often, when people are refinancing, do they stick with the lender that they've got versus moving to another lender? Often, from my experience, you're better off moving because
So refinancing in itself should mean like you go somewhere else. Otherwise, you do an internal repricing.
Yeah, and we're finding them, like we always do rate reviews for our clients, and depending on the bank, once they've got you, they're not really very friendly with offering further discounts. So it is always we review at 6 months and different touch points, because there is sometimes better rates in the market. A new to bank client might get a better rate than you that you've been sitting with them for 5 years and been loyal.
So how often should you look to swap your lenders to ensure that your pricing as sharp as possible? I know you guys would say over 2 years because...
No, I was going to say, we do a rate review at 6 months, which a lot of lenders are quite keen still at that time to do something. Then at 12 months, we do sometimes a property evaluation, and then if that drops the LVR, you might get another price adjustment.
So you can just reprice it. It's not about doing any paperwork. It's just they'll just give you a price. So could you just explain that very quickly? So the lower the LVR, the
not
greater
all banks, not all lenders, but especially if you drop under 80 and you were at 90% plus NMI, the 80% threshold will really help. And then some lenders will go and give more pricing at 70 and 60%.
Assuming that their valuation stacks up.
Yeah, of course.
So sometimes you need to fight around the valuation.
Yes.
So the less riskier you become, the greater the appetite the lender to want to keep your loan and therefore give you a sharper rate.
Yeah, and it might be the time as well where your current bank doesn't value the property under 80%, but next door bank will say, actually you are under 80%. So it's worth moving.
Shift, millions, hundreds of thousands of dollars.
I've had one recently that it was $130,000 difference in the property, and it meant moving because their current bank just wouldn't come to the mark, to the mark.
It's all a big game. They know they'll test you out to see how keen you are. So how hard is it or is it worth it just going to a bank? Hey, look, I've had this with you for 5 years. I want to pull all the equity out. You can do that, but you're probably less likely to get a better an outcome other than moving
the truth is they're only going to help you once you've sent a discharge form.
Yeah, okay.
Yeah, and also too, and depending on the bank as well, and that's why it is good to sort of speak to a broker that knows.
Is that you guys?
Potentially.
Yes,
Some bank, if you say, oh, look, I want to get equity out because I want to buy property in the future, they will then expense the proposed future debt.
Yeah.
Even though you haven't found one, they'll go, well, what's the property you're going to buy? How much is the loan? They'll add that into your servicing when you're trying to get the equity. Yeah. Other banks won't.
You've got to be careful of that, right? Like about telling banks what you're going to be doing with the equity, depending. They really, like back in the day, they didn't really care too much. But it depends how big the amount is. If you're pulling out like $600,000-700,000, they start getting a bit jittery around.
Some still don't care.
No, really, they just go do whatever you want with it.
Some under 80%. Some
and buy a racehorse.
Some of them are under 80% with, if it makes sense.
Yeah.
But other ones, they will cap it even at 100,000. Anything over 100,000, they want to retain the funds.
Yeah. So. Yeah, it gets complicated. So if you're going to refinance, most likely the best outcome for you is moving lenders.
Yeah.
Does it really matter if you move to I know I've got a personal bias. I'd rather my loans be with major banks rather than non-banks. Does it really matter that much? I know a lot of sort of people with large portfolios just don't care who it is. That dollar is a dollar is a dollar. What is the perceived risk of going with a...
It's no risk.
I don't see any. It depends on what.
So just you feel.
You go, do you want a branch network? Well, all the branches are closing anyway.
Yeah.
So it might be the features. Some might have offsets or a better online banking platform, which might suit you. But I think the major or the top lenders, big banks, compared to sort of some of the smaller market runners, they're just and if you're rate driven,
if people had all the capacity in the world, I would say probably they would say, well, stick me with a major if they could. Sometimes they're not the cheapest either, right?
That's what I find, they're not.
So, but then most people, after one or two properties, they don't work anyway with a major. So they have to look at something else if they want to keep growing their portfolio. And people are completely fine with that.
Yeah, and we're not talking about, Joe Blow's bank. It's the alternate lenders, say like an ING or a Macquarie or a Suncorp or a Firstbank, still reputable lenders, but they're just not your big four.
Yeah, well, I think what you're going to see, and you made reference to Macquarie there about what they're doing in terms of their serviceability. I saw a piece today it was including the NAB CEO, and he was weighing in the debate around sort of messing with trusts and all that sort of stuff, saying, well, stifle innovation, don't do it. But reading between the lines, you can see already the banks are concerned about mortgage volumes. Mortgage volumes are absolutely key to them. It's what drives and delivers a lot of their value and shareholder returns. So they're already seeing, like they're already commenting, saying investor loans are coming off, and they're going to start getting a bit nervous about that, I think, moving forward. And I think this may propagate maybe more of a shift, is getting more into the business of mortgages, of the major banks being a little bit friendlier to mortgage brokers, noting that you guys are at 81% market share right now. So if they're scrambling for loans, particularly from investors, most investors will use mortgage brokers.
And they may find that that's when they sort of look at adjusting their book. They might bring back the refinance offers to refinance investment.
You're going to see innovation. You're going to get certainly changes in policy. So as an investor, be absolutely connected with your broker to understand all this. I think that just the realpolitik of it all means that, yes, they wanted these direct relationships with people, but if they're starting to lose out on investor loans, they're going to get a bit jittery around it. What I would say, and obviously there is no commercial relationship here whatsoever. I got a loan with Granite, and back to my sort of bias, right? That I like sort of financing through the major banks. Well, the major banks don't do SMSF lending, and you guys hooked me up with a loan. Rebecca did actually, your broker, within Finni, for a purchase in my self-managed super fund. I bought a place down in Melbourne, and I think there was 3 or 4 options put in front of me. There was Granite, there was maybe Bluestone, blue something
Bluestone,
else,
yeah.
but
Bluestone.
there's some other Bluestone, something Sky or something.
Blue Bay?
Blue Bay,
Oh,
maybe,
Blue Bay. Maybe.
and someone else, and I went with Granite, because that was a recommendation. The rate was pretty sharp, and they had an offset account. And to your point around, is there any real difference? Well, no, I found them really good. Like, it's a bit of a shout out to those guys. Their online facility is fine. Makes sense. It's sensible. It's it's you typically find your more specialist lenders it's a much simpler experience rather than having to do things through.
I think
big
you might have
banking
the stigma as well. Like even 10 years ago, where we would ask people, "Do you want a banking app?" Because some second tier didn't even have an app.
Yeah.
It was
Or
like
they're like, I
very-
want a branch, but no, all the branches are closing anyway, and you don't need a branch.
You don't
if
need
you've
a
got
branch.
online banking or phone banking, you
Yeah.
can do everything anyway.
Yeah, it's all pretty straightforward,
Yeah,
right?
it is.
It's got an offset. You put money into it, and problem is getting money out of the offset's a bit harder. Then I've got to call them up and ask them.
we've got to be careful with offset in SMSF. The only true offset is AMP because they are a banking
Yeah,
institution. Every other one is more like a sub account.
yeah,
And there are actually talks in the industry that they're going to scrap that off completely.
yeah. I'm looking at it. It's like, they make it. It's not. To get that money back out is quite hard. So you got to be careful putting too much in it because you get trapped, right? So, so again, it's horses for courses. So, in general, are things sort of quieter with all this sort of budget noise?
I think I discussed with Julian this morning during the Broker Daily podcast. It's not that it's quieter, it's just it's changed in terms of what people want to do and how they want to place themselves. So we've seen a lot more refinance, rework my portfolio, get me ready for whatever the budget does. So I'm ready to do something when...
So people are getting ready, they're refinancing,
It's a bit of like, let's improve what I've got, like the cash flow.
Yeah, I've got clients, let's just see what I can get out. Refinance, push me back out to 5 years interest only, see what equity I can grab out, and I'll just
do full
park it.
refinances to get you another 5 years, or they because I know CBA for a while was going,
I just had one that they wanted.
No.
If because it's like a credit critical change, so they need to assess it basically. So it's basically like a new application. The client can probably ring, but they'll want an assessment to make sure that you can afford that extra term. Because essentially, if you've had 5 years interest only, your loan term's 25 years. If you want another 5 years, you've got 20 years to repay it. So they want to know that you
assuming
can.
you're going to repay it. Most people don't repay their loans, probably investors at least, until they start sort of really.
But that's how your existing bank would be sort of essentially assessing the residual debt, the term of 20 years. So
I don't know why we don't have like a lease stock type of loan for residential property where it's like investors don't intend on repaying their loan. Let's work on, can they afford the gap between the rent and the cost of it? Why don't we have something like that in Australia?
Well, maybe. I think innovation's on its way. Things got to change a little bit.
There is still the refinance exception policy floating around as well
Yes,
with some of the banks that they brought in when the rate started to increase. That if you've had your loan for 12 months, you've had good conduct, you're moving to
Cheaper.
your rate's going to be cheaper, your repayments are going to be cheaper. They have like an exception. So instead of putting a 3% buffer on when they're servicing it, they're doing a 1%, which can help as well at the moment.
So these are the shades of around the fringes of every borrower, right? Going direct to a bank again, like there's a good reason why 81% of Australians are using mortgage brokers, because you're getting access to a much wider breadth of products and they do all the work, which is handy as well, which is pretty cool. Anyway, so you guys free, available. So your new website? Can I call someone up, or is it can people just make an appointment to chat with you guys?
Yeah, I guess the easiest way is to go on the website and book an appointment at the time that works for you.
Yep.
And you'll be matched with a broker. There is a phone line as well if you want to have a quick chit chat before you book something in.
Yeah. So booking a time, come prepared. You can essentially chat about whatever you need. If it's just ask Q&As or something very specific, you're happy to get stuck into it.
Yeah.
Yeah. Okay.
Definitely.
Good. Well, thanks for your time.
Thank you.
Thanks.
Really good. Well, it's nice to know that we have some stability, at least for a period of time. And it would appear, I think 93% or nearly 100%, it depends who you chat to, of sort of economists were predicting no rate rise today. So it was expected, and despite Westpac, it sounds as though it's still a bit of an outlier. The other majors and other economists are sort of saying, hey, no more rises this year and potentially cuts next year. But, forecasting interest rate movements, like forecasting the weather, no one ever gets it right, and you never know what's around the corner. We're recording this, I think, a day after Donald Trump has announced the war in the Middle East is over, and he's done a deal with Iran, and no one else has ever done a deal with Iran, but he's done a deal with Iran.
It's not signed yet.
I think this is about the 60th time he said that the war is over there. So
Must be this time.
brokered
Friday, isn't it? Signing Friday. Watch this space.
Brokered by the Pakistanis, and I think it's going off to.
It sounds so legit.
It's going off to Switzerland to get signed this week at some point. And then there's another 90 days then when they're going to negotiate what this looks like. But this is going to be the big deal done. So, who knows what's that going to do to the economy? What's that going to do to the job rate here? What's that going to do to interest rates? Who knows? But one hot tip, just around the corner, there's going to be another crisis, and no one knows what it is. And as a property investor, you should always be prepared. What I do note, though, is that the day the deal is done, but in relation to the US and Iran, did you see on the lawn of the White House, like
the
UFC? You just got just mad, isn't it?
He is living the dream. I was going to say he's running his own race. He just does what he just does.
His birthday and the birth of the nation going, let's just do a big fight on the
He's
White
like,
House.
UFC, I'm going to do UFC on the White House because I can.
Yeah,
because he's going to tell me no.
The Thunderbirds and the US Air Force team coming together and doing their flybys. It's a big projection of the US power.
Imagine the Secret Service would have been just.
God. Yeah, it's all on, but that's the point. Who knows what the future looks like? So, what you can control is your budget. What you can control is how you choose to approach your financing, and ensure that at any point in time you're as watertight and resilient as possible, with a view towards how you can capitalise on opportunities as they come up, and no doubt they will do. Remember to check out finni.com.au, finni.com.au if you want to chat with the crew over there. And if you've got a broker, that's all cool. If you want to have a chat with another broker to get a sense for how they operate, I'm sure the team at Finni would be happy to do that. And also, I know a lot of people do outgrow their mortgage broker. There's some very good brokers out there. A lot of brokers are pretty good, and they are good for specific things. But as you become more sophisticated as a property investor, you're going to need more sophisticated capabilities in your broker. So I'd certainly back the crew over at Finni to be supportive of that. So even if you just need a second opinion on stuff or ideas, I'd encourage you to give them a call. Thanks for tuning in. smartpropertyinvestment.com is where you can find us. You can follow us on Facebook and YouTube and all over the joint, and you can have a look at some of the live streams that we're doing every Friday morning on Property Buzz if you really want to go behind the curtain of what's happening in mortgages and finance and also real estate without buyer or agenda. We get stuck into it, so go and check that out. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.